After studying this module, you shall be able to understand the meaning, scope and characteristics of the fixed income securities. To learn about the different types of fixed income securities. You would also learn to evaluate the merits and demerits of fixed income securities and understand how to derive the skills for deducing the price and yield of the fixed income securities. Let us now understand the meaning, scope and characteristics of fixed income securities first. Fixed income refers to any type of investment under which the borrower of the funds is obliged to make payments of a fixed amount on a fixed interval of time. For example, if the borrower has to pay an interest at fixed rate per annum and to repay the principal amount on maturity, then the borrower has to do so. An investment that gives yield in the form of fixed periodic payments and the eventual return of principal at maturity is a fixed income security. We know in advance about the periodic interest payment and the periodic interest payment that we will get and at what time. An example of a fixed income security would be a 5% fixed rate government bond where a rupees 1 lakh investment would result in an annual interest payment of rupees 5,000 until maturity. At the end of such payment period of rupees 1 lakh will be paid back. Generally, these types of assets offer a lower rate of return on investment because they guarantee income. Let us now understand why we should issue fixed income securities. Fixed income securities, as discussed above, make it obligatory for the issuer of the security to pay only fixed amount of interest on that security. Since the payment of interest is fixed, therefore, usually this interest payment is less as compared to other assets. Companies usually prefer to raise money from the lowest cost means of capital. Many companies also issue fixed income securities to expand three current operations. The rationale for this lies in the fact that when the companies are sure or are getting huge profits from any project, then they try to finance them with a low cost fund, and when they reap the profits from that project, then only minimum amount of profit is required to be shared by the company, and the large portion of profit after such payment is left at its disposal. Now we would understand the various characteristics for a fixed income security. As we discussed that fixed income securities are very different from other forms of securities, the features of fixed income securities can be summed up as: all those who issue fixed income securities are required to make regular payment of interest at fixed interval of time. Interest payments can be monthly, quarterly or semi-annually depending on the security type. Repayment of principal amount. The issuer of such fixed income securities undertakes to recompensate the face value when the securities mature, and some will pledge security to support interest and principal payments. Let us now understand what diversification of security means. As the famous saying goes, don't put all your eggs in one basket. Similarly, everyone prefers to keep fixed income securities along with risky securities to get the benefit of diversification. By doing so, the return from investment will never be zero. Let us now know the liquidity position. Liquidity is a measure of how easily a security can be sold in a secondary market, and fixed income securities can range from highly liquid to relatively liquid securities. Let us now know tax exemptions or tax benefits. Interest payment on securities is deducted from profits of the firm before calculating tax on that profit. Therefore, interest payment also saves tax of those companies which issue such securities. We would now learn about different types of securities. There are various kinds of fixed income securities in India. Now we will understand about them one by one. First is the fixed deposit. Fixed deposit, popularly known as the FD, is a financial instrument where a sum of money is given to a bank, a financial institution, or a company for a fixed period of time in lieu of interest at a specified percentage for the time duration of the deposit. The rate of interest paid for fixed deposit will vary according to the amount, period, and from bank to bank. At the end of the time period of the deposit, the amount that is originally given, which is known as the principal amount, is returned to the investor along with interest. The second is the Public Provident Fund. Public Provident Fund, popularly known as the PPF, is a long-term debt scheme of the Government of India. A regular interest is paid at a specified rate of interest. Any individual, whether salaried or self-employed or any other category, can invest in this scheme and can earn tax-free return on it. The third category is company bonds and debentures. Corporate bonds are debt securities issued by private and public corporations. Companies can issue these corporate bonds to meet its need for capital. When one buys a corporate bond, one lends money to the issuer, that is, the company that issues the bonds. In exchange, the company promises to return the money, also known as the principal, on a specified maturity date. Also, the lender gets a fixed interest payment on defined interval of time. The next are the National Savings Certificates. National Savings Certificate Scheme, popularly known as the NSC, is a government scheme which encourages the habit of savings amongst the common men and to use these savings in the right manner for the benefit of the economy. Under this scheme, deposits are accepted by the post offices and the amount generated through these deposits is used for the growth of the country. A tax deduction can be claimed under Section 80C for such savings. A periodic interest payment is also made as per decided by the concerned authorities. The next scheme is Post Office Monthly Income Scheme. It is a post office scheme. Under the ambit of this scheme, an investor can park his or her funds here and can get a regular interest payment on monthly basis. This scheme provides an opportunity to get regular income. However, no tax benefit is derived. Let us now understand how to evaluate the merits and demerits of fixed income securities. Let us understand the advantages first. The biggest advantage of investing in bonds is that there are very less chances that you will lose out on your investment. So, people who do not believe in taking undue risks with their money should invest in bonds. People who are nearing retirement and thus cannot afford to risk their hard earned money will find dependable bond investment very suitable. When compared to other safer forms of investment, such as saving accounts in banks, bonds pay a much higher rate of interest. Therefore, instead of keeping money in a bank, people can invest in bonds and earn a good interest rate, at least better than the saving account interest rate. Secondly, with fixed income securities, there is no anticipation and anxiety over when the principal amount will be paid or when interest will be received, as everything is pre-decided and the investor is aware of the maturity date and the time when interest is due on his investment. Thus, fixed income securities do not need constant monitoring like some other investment instruments. Lastly, certain fixed income securities such as municipal fixed income securities can sometimes be exempt from income tax. This adds on to the profits earned through them. Let us now consider the disadvantages. The foremost disadvantage of fixed income securities is that when compared to shares, gold and real estate, the rate of interest that they generate is far very less. That is why people who want to double or triple their money or investment with some good investments, they do not put their money in a fixed income security. Another disadvantage of fixed income security is that there is always a risk of the company which has issued the fixed income securities going bankrupt. Considering the effect that the economic recession has had on various businesses in the recent past, this is one possibility that cannot be completely ruled out. So, if this happens, the fixed income securities will not yield any interest, plus the investor may lose out on principal amount as well. Then there is one issue related to long-term fixed income securities. The duration of the long-term fixed income securities can be anywhere more than 12 years. If an investor's money is tied up in such low-yielding long-term fixed income securities and suddenly the interest rates of banks or other fixed income securities goes up, there is nothing much the investor can do about the situation. In such a case, an investor will end up making much lesser money as he could have if they had invested in other instruments. It can be said that fixed income securities, if purchased during one's middle age or near retirement, can turn out to be a good investment as they generate a regular income. However, particularly youngsters who have the capacity to take risks and are looking for high yielding investments should definitely look elsewhere. Let us now understand how to derive the skills for deducing the price and yield of fixed income securities. Yield is a total amount, or it can be said to be the percentage to cost or price of a security that displays the return one person or holder of fixed income security gets on it. The simplest kind of yield is calculated using the following formula. Coupon amount price when you buy a bond at par, yield is equal to the interest rate. When the price changes, so does the yield. Let us now know the relationship between price and yield. The relationship of yield to price is as follows. When price goes up, yield goes down. And number 2, when prices go down, the yield goes up. So one can say that price and yield are inversely related. However, the likeness of an individual for a high price or a high yield depends on his situation. For example, an individual who has taken bonds and wants to hold them would be more interested in holding them, whereas the one who wants to sell them would like to get high prices for his holdings. Thus, we can say that the factors of face value coupon, maturity, issuers and the yield etc. play an important characteristic in its price. However, the factor that influences a bond more than any other is the level of prevailing interest rates in the economy. When the interest rate upsurges, the prices of bonds in the market would fall, thereby nurturing the yield of the fixed income securities and bringing them in line with newer bonds being issued with higher coupons. When interest rate falls, the prices of the bonds in the market would rise, thereby lowering the yield of older bonds and bringing them into line with newer bonds being issued with lower coupons. Now, let us recapitulate what we have learned so far. Fixed income refers to any type of investment under which the borrower of the funds is obliged to make payments of a fixed amount on a fixed interval of time. Fixed income securities, as discussed above, make it obligatory for the issuer of the security to pay only fixed amount of interest on that security. Liquidity is a measure of how easily a security can be sold in a secondary market, and fixed income securities can range from highly liquid to a relatively liquid market. Interest payment on securities is deducted from profits of the firm before calculating tax on that profit. Thus, interest payment also saves tax of those companies which issue such securities. Fixed deposit is a financial instrument where a sum of money is given to a bank, a financial institution or a company for a fixed period of time in lieu of interest at a specified percentage of time duration of that deposit. Public Provident Fund or PPF is a long-term debt scheme of the Government of India. A regular interest is paid at a specified rate of interest. National Savings Certificate Scheme is a government scheme to encourage the habit of savings amongst common men and to use these savings in the right manner for the benefit of economy. The foremost disadvantage of fixed income securities is that when compared to shares, gold and real estate, the rate of interest that they generate is very less.